Today, Caleb's going to grill me on my trading failures and abandonment of everything I knew to be true.
We'll see how it goes. Well, the first question is explain a little bit about your trading philosophy as it pertains to what we're going to talk about. And then, it uses zero DTs, so explain zero DTs to a beginner.
Okay,
But yeah,
yeah. When I reference zero DTEs, I'm referencing options, which are a stock tool that can be traded publicly. An option is a contract that says I have the right to buy or sell the underlying stock for price X as long as the price on this expiration date is above or below Y. So it's a derivative, usually trades in 100 contract or 100 stock per contract. So there will be some price for a contract, and you can buy or sell a contract, and that contract controls 100 shares of the underlying stock. So almost every publicly traded NASDAQ, whatever, you can option. And there's a pretty big market, especially once you get into the indices, SPX, SPY, pretty big market of stock traders. And a lot of the big stock traders are using it as a hedge. So in their day, they may take a position in some company or even in an index and buy or sell options as a hedge so that at the end of the day, if something moves against them or something in the market happens, they will they call it delta hedging, where if a big movement happens, not much movement happens in their portfolio. Sort of background of options there. So they're a derivative, they move quickly. You make a lot of money in options, you can lose a lot of money in options. Just like everything else in which you can make lots of money, there's lots of people that think they can make lots of money and don't because things move quickly. So
so I know
that's sort of the
I know I just asked you about your philosophy, but one question I had about what you were saying, if they use it for hedging, wouldn't that just lower the overall gain that they have? And if not, why not?
okay. So that question is actually getting into a book that I am reading, which I told my wife is either going to be the best book I've ever read on investing or it will be a nothing burger. But I'm almost done with it. It's called Safe Haven by Mark Spitznagel. And Mark is a contemporary of Nassim Taleb, who wrote the book Black Swan. Both Mark and Nassim, their trading strategies, they were both influenced by George Soros, but their trading strategies are you've got some safe, predictable portion of your portfolio that by definition probably makes less than market returns. But you have a small portion of your portfolio in highly speculative or statistical return vehicles that basically costs you a little bit every day or every week, but is your insurance policy. And when a 2008 or a COVID or whatever crash happens, that portion of your portfolio makes so much that it makes the whole portfolio outperform the market over whatever period that it was doing nothing for.
Uh,
Nassim Taleb, I don't know if he coined the term, but he's a proponent of what he calls the barbell approach, which is this idea that you've got two sections, one highly speculative, which is a small portion, and then one section, which is your safe stuff, and you get this kind of barbell distribution of portfolio funds. Where was I going with that? So Safe Haven is this treatise on the ability to reduce risk and increase returns is not necessarily true, albeit it's very difficult. So the idea is the way you perform these functions, you've got three basic hedging tools. One is a store of value. So when things aren't going my way, I'm going to move into cash or bonds or something that does not perform by itself very well, but it saves my butt. I'm not going to lose any money doing it. Then there's the alpha hedging, which can or cannot be gold, depending on who you ask. Like, it's in theory kind of a safe investment, but also has been known to drop. But it is a little more counter-cyclical, not necessarily with economic downturns, but with interest rates. So if you add a 20% gold to your portfolio, you stand a better chance of making money in a downturn when the rest of your portfolio is down. However, your 95% chance of ending that portfolio higher than if you just put all your money in the market is pretty low. So at the tail end of the book, they walk through, like, here's different hedges that people use, and your chances of having a portfolio that is both less risky and better returns than if you just put in the market. Here's your statistical chance of that happening. And then the third, so you've got your store of value, your alpha, and then what they call insurance. And your insurance is, here's the thing that I pay for that does nothing, but on a downturn makes a lot of money. Options, if you could find them for a cheap enough price, would be in that category. Because if I buy a put option that's, I don't know, out of the money, it's a 30 delta, meaning it is there's a certain chance, there's a 30% chance on any given day that price drops below that option, the 30 delta. If I buy that option every day, it's going to expire every day and be worthless. Until there's a day where price drops so low, it's below that strike price, the 30 delta, and then I get paid big. So now the obvious pushback on that is, this is very dependent on what your 30 delta put option is worth every day and how much you pay for it, because there foreseeably could be a price in which over the long term this loses money and a price at which it makes money. Anyway, it is possible to reduce risk and make more money, but it's not easy. Did I answer your question?
Well, if it was easy, then a lot of people would be doing it, and it wouldn't be easy
that is
anymore.
Absolutely correct.
So now explain your philosophy a little bit, like how you used zero DTEs and options.
Okay, so the zero DTE, I should explain, options have an expiration date, and they're dated a certain amount of days from today. So a zero DTE option means it's 0 days till expiration, meaning you're going to buy that thing today, and by the end of the day, it's either going to be in the money, which means it's going to be worth the difference between the strike price and the current price of the underlying stock, or it's going to be zero because it's not in the money. The contingent, I have the right to buy this stock at price X if the price is over price Y, is not true, so it's gone. There's a little edge in options generally because of the way that they're priced, and people will call this the I can't remember the term, but it basically, if the market drops much at all, the price of options increases, because the theory is things are dropping, there's uncertainty, so if you are to sell one of these contracts, you'll get paid better for selling something during uncertain times. So this uncertainty also seems to be a little mispriced. If you were able to sell a bunch of contracts that were delta hedged and then they all expired, some of them are going to have moved against you and some of them aren't. And overall, you will have made money because it seems that people misprice volatility. The what they're willing to pay for seems to be higher than what the math says should be available. The problem is most traders don't have the money to be trading 1,000 options a day because they're pretty expensive. I mean, they are a derivative, so
I can trade 1 million. No.
right.
No.
So I think a volatility premium, I think is what it's referred to.
Oh, like
Don't hold me on that. I've listened to so many hours of people talk about options. You think I'd remember the terminology? But volatility risk premium. So most of what I was doing in 0 DTE is I did a whole bunch of back testing, which everyone says back test, historical data is not what's the financial advisor
historical data
it's indicative
will not equal future values.
Yeah.
Not guarantee future values. Or
yes.
Yeah.
So we know that we can't necessarily predict the future of markets based on the past because we have had regime changes where fundamentally there's just more volatility for this decade versus the last decade, or if you're in Japan, the stock market just barely budges for 20 years as a whole. And when I say the stock market, I mean the big indices, SPX or Dow Jones, are the equivalent in Japan. So there are different times where the market does different things, and that can vastly change the outcomes. But what I was doing was back tested the last 3 or 4 years post-COVID. Post-COVID, for whatever reason, we have been in a highly speculative, the market has moved a lot more, both to the upside and the downside, than previously, pretty consistently. So what I was doing was back testing a little bit before COVID, several different strategies for if I sold this set of options every day at the same time, statistically, how many times does that end up in the money? How many times do I lose? How many times do I win? And when I lose or when I win, how much do I lose and how much do I win? And what you're looking for is, I want something that
more wins.
Either wins a lot when it wins, but may not win very frequently, or something that wins very frequently, and consistently, so that you're making money on your occurrences. The reason that 0 DT is appealing for this is because that's basically what everybody else is doing when they're swing trading or even buy and hold. It's a path dependent process. Yesterday's returns do change how today's returns are, and I'm either planning on buying now and selling in 30 years, or I'm planning on buying now and selling at the end of the week. And you want your second number to be bigger than your first number. And it doesn't really matter what happens in between as long as you end higher than you did before. Now there are, in the real world, there are tax implications and all that. But
yeah,
this is just a real basic model. So I created 1, 2, 3, 4, 5 different means of selling options. There was kind of in the morning, on certain days, the volatility is high and it tends to collapse throughout the day. So that was one of them. And then a couple were like trend following. So when we get to noon or 2 p.m. or whatever, if the 20-minute price movement is above my graph of 40-minute price movement, sell an option, et cetera, et cetera. And I chose these specific ones because I've come up with several things that look profitable. And I chose these specific ones because I wanted to nominalize my risk at 10%. So I know that I'm going to lose some. And these particular strategies historically have been somewhat uncorrelated. So if I throw one of these strategies, if I have 4 and I throw the 5th one in, it actually reduces my maximum drawdown because when that one loses, these other 4 tend to win. Mm-hmm. So that's kind of the strategy I was getting at. And if something pushed me over the 10% drawdown in a backtest, I would remove it unless it was so good that I would replace something else with it. Because just the emotions of buying and selling, when you see drawdowns, it sucks. I'm a bad discretionary trader. My emotions betray me. And if I don't have a strong enough thesis on, this will turn around, which I don't with 0 DTE, then I can't make the positive argument. So I know if I get in a 20% drawdown, I'm going to be like, when is it time to abandon this whole thing? And the worst time to abandon a strategy that might rebound is on a drawdown. So that was my thought going into it. And I know my maximum drawdown is going to be more than 10% because that is statistically likely to happen at some point if I were to do this for long enough. So then come to, I don't know, 2 weeks, 3 weeks ago? How many weeks ago did I say things are looking crappy?
Probably 3.
Okay, so 3 weeks ago, we'll say, I was up 20 at my max, 22%.
Sheesh.
While the market was at, did we hit 18?
Something
15?
like that.
Markets dropped back, I think, down to 12 or 11. I've now dropped back to my starting, which was in, I forget when I went live, April of this year.
Yeah.
So I made 22% and now have lost 22% in 3 weeks. And go back to my comment that I nominalized this portfolio at 10. So we've now doubled my maximum drawdown, which if I had a thesis that this kind of thing happens, it's probably going to rebound, and I'm confident of that, then I would have reason to stay in. But as it is now, if I can't fundamentally go from the positive articulation of this is going to turn around and here's why, I'm probably going to kill this animal, take it out back and shoot it in the head.
Wow, brutally.
So things that I am happy about, I am frustrated because it's like, really? This stuff worked well for 5 years, and then all of a sudden when I start doing it, it messes up. But it is nice to know that I controlled my risk, because in a good time and when your back tests look great, and even when you're making, when I'm up 22%, I'm thinking wow, it's really tempting to do 5 more contracts of this because I'm just raking in money. But I didn't do that because I know a drawdown is coming. A drawdown will happen. I don't know when, I can't predict it, but something is going to go wrong, which is why I control risk. And fortunately, the sane part of me won out, and I did control risk. And over the course of 3 weeks, have watched my previous data get blown out of the water. I don't think there's a profitable strategy that I have run in the last 3 weeks, all of them, which statistically was going to happen at some point, but was crazy unlikely to start with. And it was likely if I had run this over the course of years.
Yeah.
it's not super surprising, and I'm glad that I've only lost what I started with. So
Yeah.
like I'm back down to what I started with. Where was I going with that? There was some further.
Is the rest of your portfolio still above where it was at the beginning of the year, though? Okay,
Yeah.
so I mean, you
Yeah.
haven't necessarily made zero this whole year because this is a
No.
portion of your portfolio.
Yeah. So I would have to go calculate it, but I'm obviously underperforming the market now because it wasn't a small chunk of my portfolio, but I at least didn't lose any time other than the 6 months that I was well, more than that, because I was testing it before I went live.
Yeah.
But I don't know if you remember me mentioning, I suspect at some point that, and I think I mentioned this on Wednesday too, I had told, I think you and my wife and somebody at work maybe, who was asking me about it. I suspect at some point the edge of what I was doing in zero DTE will disappear. I think there will always be edge there for somebody who's just living and breathing it every day. Just like people lose money in futures, but there's always some trader that you hear about that for every 1,000 that destroyed themselves on trading futures, he made out like a bandit and continues to do so on a daily basis.
Yeah.
But I think I've come to the conclusion that after putting, I don't know, maybe 100 hours into this, maybe more, depending on how quickly the regime changes in the market happen, I'm going to have to do this over and over and over again. And it's just easier to find good companies and buy them.
Yeah.
It's fun to do this, but like I said, I'm a bad discretionary trader and my emotions get the best of me. So when I'm looking at a 20% drawdown, it already sucks. But then additionally being like, man, if this had happened when I first got in and I had a 20% drawdown on my entire portfolio, like if I had gone all in while everybody else is up 12, I would have felt miserable.
Yeah.
So
Would you have,
anyway,
so if that had happened and it was like at the beginning when you weren't up 20% already, would you have stayed in it hoping to get back to baseline, or would you have sold and done something different?
I don't know. Obviously, it's theoretical.
Yeah.
I probably would have still abandoned it, but at great emotional turmoil. I don't like, in theory, it's not that different, but emotionally, I think it would have been a little harder to stomach.
Yeah.
Yeah. Either way, the point is I had an expected outcome and expected a bit of deviation. You know, drawdown 12%, drawdown 14%. It might be within the bounds of acceptability if I tested and nominalized to 10. But at 20%, basically, it's like this is blowing what I knew out of the water. And so if I say like, well, this will bounce back, do I really know that? I'm like, clearly my powers of prediction are not as good as what I thought they were. So, are you going to toss a coin and stay in it or not? And maybe I still have the backtesting software, so I might watch it and just see what happens. But I'm probably going to move that portion of my portfolio to one of the other two strategies that I have that are working. Like we've got an account that I've shown you where I'm trading TQQQ, kind of a momentum strategy, and that seems to be doing fine, making money there. And then I've got another portion of, like, my wife's retirement is doing individual equities, and that's still positive, making money. I can't remember if I'm at market returns this year or not, like year to date on that one. So I'll probably move to doing one of those two strategies. But yeah, it's disappointing.
Yeah.
The theoretical upside of that one was quite large.
I remember you showing me some of those graphs, and I was like, Wow.
But
That is insane.
yeah, but they're all based on the past being true as it is today,
Yeah.
which clearly is not the case, or at least not currently. And I don't know for how long that'll be true. Oh yeah, what I was going to say is I feel like the edge in what I was doing was likely to be reduced or eliminated at some point because I'm a pretty late adopter. And so if I am using a bot and backtesting a trade and then implementing that, a bunch of people have done it already because I'm not an early adopter. And then I'm going to be on the tail end of right before everybody else does it too.
Mm,
And it's relatively clear that in some areas, when everybody gets into something, the edge disappears.
yeah.
Now, that seems not to be the case with indexing, but it's kind of based on weighting. The way market cap indexing works is improved the more people that are in it. So it's kind of a positive feedback loop.
Yeah.
So I do feel nice that I predicted. I suspect the edge here will eventually disappear. I don't know when. And now my edge has disappeared. It might come back, but I don't know why it disappeared or why it will come back or when.
Yeah. Sometimes you gotta take the L and just move on to
Yep.
something different.
Yeah. But the takeaway from this is it's fine, go experiment, but control your risk. Because
Yeah.
if I'd put everything in, I'd be sitting here with basically nothing. And there are lots of people who do that. Or they trade nakeds, which I know a guy who trades naked options, meaning you don't actually have enough money to buy and sell these options. You're doing it on, yeah, it's leveraged. It's on debt, a loan from your broker.
That is crazy.
I know of people who make money doing it, but there's a lot of people that lose all their money doing it. So control
Well,
your risk.
they lose the money they didn't even have and therefore
Yeah.
go to debt further.
Yeah.
That's crazy. Yeah. I don't think I would ever do that. That would be quite.
I am not opposed to ever doing it in theory, but I also would need articulated how are you doing this to control your risk severely.
Yeah.
This safe haven book that I'm reading is, from a trader's perspective, is really fascinating because he's talking about almost exactly what Howard Marks, you know who he is, so like a hedge fund manager,
Yeah.
what he talks about, where volatility is really just a different way of stating multiple future outcomes. So if we get into investment and it's high volatility, what that really means is the distribution of where this lands after we get out of this investment is unpredictable. We don't know if we're going to be up 20 or down 20 or somewhere in between. And the size of the landscape of possible outcomes is huge, as opposed to a less volatile future me with an investment being in bonds. The range of possible outcomes of future me having been in bonds is like +3 to +50. The ending range is huge. So he's like, basically what you're trying to do when you control risk is you're trying to make the unpredictable far more predictable and move your bottom outcomes of life above zero. So by controlling your volatility, by reducing your risk, you kind of want to control volatility and move the whole graph above zero. That's the goal. Not always possible, but that's the
And
goal.
there's a reason why the people who can do that are much richer than we are.
Very much so. Very much so.
Interesting.
Questions, comments? Am I going to lose all my money? Am I crazy?
If you had to, not that you're giving personalized investment advice, because that's you're not
Yep.
giving personalized investment advice, but based on your experience, who would be the kind of person that maybe should try and basically everyone else shouldn't?
Yeah. Well, if you're not interested in spending copious amounts of time looking at investments, then don't do it. Just index. I have a coworker who dabbles in real estate, and her comment is constantly, "It's just too easy to make money in the market. Just put your money in an index, and you won't have to worry about it. Or if you really need to, get a financial advisor." I don't necessarily want to do that because I enjoy the act of allocating my own funds, and I think I can probably get better returns. In this case, that's not the case. That's not true. Um, but I have told people, like, look, go index. But also, if I say that and you're thinking in the back of your head, when am I going to have time to do it? Just call a financial advisor. They'll be your exterior motivation to put your money in a. You're not going to lose probably by going to a financial advisor. You might not make as much as if you did it yourself, but I don't think you're going to lose.
Yeah. Does your coworker, who I know, does she use a financial advisor? I can't remember.
She technically has a financial advisor, but she
Well,
doesn't really have any of her. Yeah.
okay.
That's because of a specific scenario.
Yeah.
But she doesn't really use her for her investments. That particular coworker is also kind of a retire early person, so
Higher.
she's pretty on it with
Yeah.
managing her own stuff.
Yeah.
She's
No, that
she's
makes
certainly not ignorant of financial matters in markets.
Yeah. I actually had a meeting yesterday with that financial advisor who she would have.
Oh yeah.
And I'm just going to roll over the stuff into my own account. That way I don't have to log into multiple different platforms because
Is it difficult to do?
I don't think so. I was like, is there any, like, what should I do in order to roll it over? She just said on my current account that I have for all my personal stuff, start a rollover IRA, put in the account numbers or statements or whatever from the other account, and it should automatically.
Nice. It's just like account and routing, basically.
I think so. Yeah. And
Okay.
I've done it
Good to know.
before from another firm, but I didn't know if like she had to do something,
Yeah.
the financial advisor, or if it was all me. So
Right.
yeah, but it should be
Right.
pretty easy.
Good. That's exciting.
Yeah.
That's good to know if I ever want to move my money out of that account.
Well, I know you're past the 2-year mark. Oh, by the way, the financial advisor did say that it's when you start the account, not based on each contribution.
Oh, okay.
As long
Nice.
as you've had the simple IRA for 2 years, then you can roll over the money once you leave, or I don't know. Well, if you can't manage it yourself, according to your company, then you would have to keep it in there. So once you leave, you could roll.
Yeah. Gotcha.
But yeah, which was nice because I was like, oh man, if I have to wait for the July contributions for 2 years, that's going to be kind of annoying.
Yep. Yeah. For those of you who did not follow that, we're talking about a simple IRA, which is an alternate to a 401k, more or less.
For smaller companies. Yeah.
Yeah. Yeah.
It doesn't cost as much overhead to have a simple IRA versus a 401k.
Right. Right.
Yeah.
A little easier to manage.
Yep.
Questions?
I mean, that's all the questions I have for you. My takeaway is basically I'm not going to get into zero TTEs. I'm going to keep indexing.
Sounds good.
That's what I'm going to do. So
Sounds like a plan. If you don't enjoy it, don't do it.
I don't think it would be that bad in terms of like, it would be cool to do some financial projections and stuff, but just the extra work right now, I'm kind of more focused on other stuff. So,
Yep.
no.
You and most everyone else.
Yep. So yeah, that's all I got.
Okay. Where can people find us?
Email us. Well, obviously you're watching on a platform. You can also watch on other platforms. We have Spotify and YouTube, and then send us an email at jc.unscripted@gmail.com. We would love to hear some ideas or comment on Spotify or YouTube. Comment what we should talk about. So, all right, that's the pod.